My name is Brenda Blunt. I am a tax partner with Eide Bailey. I work in the exempt organization practice and have specialized in exempt organizations for the vast majority of my career for 25 years. So, and this is just about all I do, is provide tax advice to organizations who arguably don't pay tax. So I enjoy my job, and I'm going to let Candace introduce herself.
Morning, my name is Candace Mushat, and I'm a partner at Ballard's Bar. And like Brenda, I specialize in tax exempt entities, and this is pretty much all I do and have done for many, many years of my 20 plus, almost 30 years worth of practice. So Brenda and I practice a lot together, representing a lot of organizations that don't pay tax for one reason or another. So shall we get started on the substance here? So we're generally going to talk about a lot of nonprofit organizations today. We may focus a bit on the C3s, in part because the C3s tend to have some stricter regulations than other nonprofit organizations. But remember that sometimes when we're talking about the C3s, those are the most restrictive rules in the tax code. So that's why we mention those. But generally, as a nonprofit tax exempt organization, and a lot of times those are used interchangeably, they may or may not be interchangeable, but we tend to talk about nonprofits as though they're all tax exempt. But really, you have two sets of overarching rules. You have the Internal Revenue Code and Treasury regulations that set out filing, reporting, disclosure requirements. And then you have the state nonprofit statutes, which impose, again, various reporting, filing, and rules that relate to duties that are imposed on directors and officers. And many states across the country, there's about 40 that have used some version of the Model Nonprofit Corporation Act. And then in addition to that, you also have the nonprofit organizations, articles of incorporation, bylaws, and policies, which are also going to govern the activities of that organization. So there's lots of layers of rules and governing documents. So in a 501c3, as with most tax exempt organizations, you're probably exempt from income tax unless you have unrelated business income tax, which we call UBIT, or you might see it as unrelated business taxable income. So the last two letters could be switched around. You also may be exempt from paying sales and use tax. It's going to depend on the state law and on the specific activity. And you may likely be exempt from property taxes. Again, if you're a C3, both of those latter two are going to be, often you're going to be exempt from, but if you're a C4, a C6, a C7, a C something else, you may not be exempt from sales and use tax or property taxes. And only if you're a C3, for the most part, can you provide a charitable tax deduction for donations. If you're a C4, a C6, a C7, you usually don't get to provide any kind of charitable tax deduction. If you're a C3, you're going to be extremely limited in the legislative and the lobbying that you can do. And you're absolutely prohibited from engaging in any type of partisan political campaign activities, whether it's at the state, local, or federal level. So no PAC contributions, political action committees, no endorsement or opposition of candidates. If you are another kind of C3, you may have unlimited amounts of lobbying. You may be able to participate with some candidate activity. So again, we're telling you about the most restrictive type of activities. And as an officer and a director, you need to understand what the limitations are on your organization. So one of the things that of any type of corporate entity, you're going to have fiduciary duties that are imposed on you. And these are derived from state law, and they're usually on the officers and the directors to act in good faith, or in some states it's called a duty of obedience, and then a duty of care and a duty of loyalty. Those are the overarching three duties. A duty of faith, of good faith, or a duty of obedience, depending on how your state presents it, is usually acting with an honesty of purpose and honesty of fact. Be faithful to the organization's mission and don't act in a way that's inconsistent with the organization's stated goals. So you're really supporting the purpose of the organization. The duty of care is to act as an ordinarily prudent person would in a like position under similar circumstances. So you can see there's a lot of room in here. How does an ordinarily prudent person act? If you've got 7 or 8 or 11 or 15 people on your board, you're probably not all going to act in exactly the same way in what is a like or similar position. So boards of directors or officers under similar circumstances. These give you a wide latitude. You're going to look at facts and circumstances when you're taking some action, look at all the surrounding circumstances and use your best judgment. The last duty is the duty of loyalty. And this is where we see quite a few issues pop up because it's in this situation where conflicts of interest come up. So a duty of loyalty is to act in a manner that the director or officer reasonably believes to be in the best interest of the organization. So notice it doesn't say in what's in your best interest or the best interests of you and the organization. It's in the best interest of the organization. So you're always supposed to be putting the organization first when you're sitting as an officer or a director. So as I mentioned, this is where we see conflicts of interest come up. And when you're sitting as an officer or a director, you're not required to do everything yourself. You are allowed to rely on officers or employees if you believe they're reliable and competent in what they're telling you. You're allowed to rely on legal counsel, public accountants, if you believe they are within the person's professional or expert competence. This is an area where as a lawyer, and I'm sure Brenda as an accountant, a lot of nonprofits want to have a lawyer and an accountant sitting on their board. And they think that whatever the lawyer or the accountant says is going to be golden. One of the problems with this is, as a lawyer, for instance, my specialty is tax exempt entities. So you do not want me giving you advice on a real estate transaction or on perhaps a personal injury matter or something else that may come up, labor and employment matters, for instance. And just because a lawyer has legal background in a particular expertise does not make them an expert in all legal matters. So you want to be very careful about relying on everything that comes out of the board member's mouth that's sitting on your board that may not be within their legal competence, because that may not cover you. The other thing that we always caution people about in organizations is when you have a lawyer sitting on your board as a board member, those communications are usually not covered by the attorney-client privilege unless the lawyer acting as a board member is also the actual lawyer for the organization. So you have to be very careful about some of the conversations that you have, thinking that just because the person is a lawyer, your discussions may also be covered by the attorney-client privilege. The last group that you're allowed to rely on is a committee of or appointed by the board. Again, if you believe that the committee merits competence. A lot of times something will go awry in an organization and there's always somebody sitting around the boardroom that says, ha, I knew the person wasn't competent. I knew we couldn't rely on them. I knew they were a bad apple. And what that person has just done by not having spoken up earlier or by not alerting the board that they thought there was a problem is acknowledged basically that they've reached their fiduciary duty because they didn't tell anybody, they didn't sound the alarm bell. So you really want to be careful about those kinds of things. And if you'll note at the bottom, what we've noted is that you cannot rely on something and fall back on, well, the committee said, or whatever it is, if you don't believe that either the committee is within their area of expertise or the employee or the legal counsel or whatever it was. So you really do have to rely in good faith, which goes back all the way to the first duty that we just talked about. The business judgment rule is codified in nearly every state in some way that basically says you're not going to be liable for any actions that you've taken if you complied with all those duties. You acted in good faith, ordinary care, in a manner that you believe to be in the best interest of the organization. So again, it's a layer of protection that if you comply with your duties, we're going to be able to protect you. So conflicts of interest, as I mentioned, are the things that come up, and you're going to know it when you see it. A lot of people try to ignore it, but you know them when you see them. They can be with management, staff, officers, directors, family members of any of the above, or businesses owned or controlled by any of the above. The penalties for conflicts of interest are intermediate sanctions, which we're going to talk about, excess benefit transactions, that's a federal provision, or revocation of exempt status, again federal, or voidable contracts, which are at the state level. So there's lots of penalties if you engage in conflicts of interest and they aren't handled properly. You'll notice that I didn't say you absolutely positively have to avoid them. And a lot of people think conflicts of interest are just bad no matter what, but we're going to talk about that, and that is not always the case. So a conflict of interest is exactly what you think it is. It's somebody that's affiliated with the nonprofit organization that has an interest at the time of the transaction or a decision. They've got some kind of financial interest, or someone they're related to, a business they're related to, or a person has with the nonprofit organization. So it's really exactly what you think it is. If you have a conflict of interest, or someone else on the board does, it needs to be addressed by the interested person, the person with the conflict, or the family member that has a conflict, or a business that has a conflict. That person that's sitting on the board or the officer needs to make a disclosure. They need to then allow the disinterested or the qualified directors or a committee to evaluate the transaction. And then a decision should be made on the transaction only by the qualified or disinterested directors without any influence of the interested directors. So this is often why conflicts of interest policy will recommend that the interested person leave the room, stay out of the discussions. It's a little hard to make a decision without influence if the person with the conflict is staring you down or making you feel uncomfortable about speaking your mind. So I have a lot of clients who will say, well, why do I really have to leave? Make them leave the room. And then you want to adequately document the basis for the decision. This is where a lot of organizations fall apart. They may do all the due diligence, they may investigate alternatives, but they never adequately document why they decided to go ahead with the transaction that's a conflict. So we have a question here about a situation where a director is an insurance agent and a person wants to market the insurance for a nonprofit. And the question is, that would be a conflict, correct? The answer is correct. That's a conflict. But that doesn't mean that that can't happen. So let's assume that the situation is you have a director that's, maybe you run a charter school, or the situation where the director wants to market the insurance. The director needs to make the disclosure. This is my interest. I run a charter school. And I also own a book company. I want to sell you all the textbooks. I'm an insurance broker. I want to market all your insurance. I'm making the required disclosure. And then there's going to be a committee or some disinterested directors, and they are going to either go out and get market bids, or they're going to take a look at, if you market our insurance, are you getting anything special that an independent, disinterested person would get out of this deal? And so you look at the situation, decide how it is you're going to evaluate it to ensure there's not something above fair market value that the interested director is going to get. And then you may go out, as I said, get bids or do whatever you're going to do, and compare it side by side with what the interested director was going to do. Let's take the textbook example, for instance, and you would have them go out and get a couple of bids for textbooks. So let's assume you do this, you come back and you compare the bids. And maybe the interested director's bids are, he's going to sell you all the books at 5% below market, or 10%, or even at market, but he's going to provide free shipping or something like that. The disinterested directors will then make the decision. They'll take a look at this. And Brenda's going to talk to you a little bit more about how you look at fair market value. And there's a reason, a federal overlay to all this, a reason we're talking to you about this in so much detail, because it comes up in, I can't even think of a nonprofit that I've represented in over 20 years where this situation doesn't come up. So it's really important that you understand these rules. So let's assume that you decide to take the interested director's situation and you take their bid. You then document why you accepted that bid. It was 5% less than every other bid we received. It was for all the same benefits. It was free shipping. It was whatever it was. There's a business reason for accepting the interested directors, the related parties bid. It's not because the person has 3 kids to put through school and they're a really great guy and they needed the money. That's not a business reason, right? So what you really want to do is take a look at this and see if it's a good deal for the organization. So that's what we want you to do. And we also have a question. Yes.
Do you always have to take the lowest bid?
You don't always have to take the lowest bid, Brenda. What a great question. So you want to take a look at all the facts and circumstances. So there may be, I had a situation a few years ago where there was a director that was catering an event. They used his facility. They actually, it wasn't the lowest bid, but they had used a couple of other facilities in the area. The surrounding facilities were not so great. And because it wasn't the lowest bid, they went elsewhere. The food was cold, the venue was dark and unappealing, and they had dropped attendance 2 years in a row and a lot of complaint about the facilities. So they went back to using this director because there were a lot of benefits to the other facility that they had been using that was owned by this director. So you really have to look at all the facts and circumstances and document why you're using the bid that you're using. Do you want to add something to that, Brenda?
No, I think you get what you pay for. The point is, don't take your business hat off when you are sitting on the board of a nonprofit. Make a good business decision and consider that sometimes a low price ends up with a longer term high price tag. In your example, they lost revenue at their event that probably far exceeded the difference in the venue. So
it did. And again, we're emphasizing you really need to adequately document why you're selecting the related party transaction. So don't forget the last piece, and that's going to become really important in a few minutes when we talk to you about the intermediate sanctions section here. So we have another question about these are all financial. Are there non-financial areas of conflict? So sometimes this will come up, and one of the ones I always caution my clients about is when you have directors sitting on multiple boards of directors or officers. And so there is the appearance of conflict, particularly when one may be making grants to other organizations in the communities. And so just because perhaps somebody sits on one organization that's making grants out into the community and they sit on another board of directors that may be applying for grants, I caution that the director may want to recuse themselves from the grants committee because it will look like there's favoritism in making grants. So you do always want to think about the appearance as well. Brenda, do you have something that you'd like to add on that?
well, there's also conflicts. So when you're sitting on multiple boards, they may be, there's nothing inherently wrong with that, but there may be some trade secrets for one organization that we often want to say, well, I sit on another board and this organization does X, Y, and Z, and I think that's a good idea for this board too. sometimes that might be fine, but sometimes that might be disclosing confidential information from one organization that, so you can't really, that can create a conflict. Or if two organizations are suing each other and you sit on both boards, that could create a conflict. So there's other sorts of non-financial conflicts that frequently aren't directly addressed in a conflict of interest policy, but should be considered as you participate in discussions. It may, you know, at a minimum, disclose that I sit on another organization that's going after the same contract. So maybe I shouldn't be part of the discussion about our strategy for how to win. You know, there might be some instances like that.
And picking up on what Brenda just said about confidential information, remember, you always have to act in the way you reasonably believe to be in the best interests of your organization. So you have to always be careful about disclosing confidential information. Let's assume that you do sit on two organizations that may be competing for the same contract. You may not be able to disclose that information. So you might not be able to say to organization A, oh, well, organization B, we're applying for that same contract. What you may have to do is simply recuse yourself in both instances and say, I'm not going to be able to vote on this for various reasons that I can't disclose, and leave it at that. And sometimes it's very hard to simply close your mouth when you need to, without, you know, wanting to say more, but without disclosing confidential information. So you really have to be very careful about that. And there's a lot of times in the nonprofit community, people are so nice and they want to be nice and they want to be helpful, but you have to be careful about disclosing confidential information. And we see it all too often in the nonprofit community where things get out that really shouldn't have been talked about. And keeping organization confidences is a really big one. So we have a question here about, the question is, give us the mechanics of and the rationale for the interested person to recuse physically from the room during the discussion and the vote, even if the interested director is abstaining. So I will tell you, it's unfortunate we can't be in person here because I'm only a 5'2" and not a very physically imposing person, but I will tell you, when I do these seminars in person, I have made more than a few people extremely uncomfortable in person, because as I'm doing this conflict of interest discussion, what I tend to do is slowly make my way in a rather nonchalant way up to some person I do not know in the audience. And I stand within about 6 to 10 inches from them. And while we're having this discussion, I'm staring them down, and you'd be amazed at how uncomfortable someone gets. And as we're discussing this, I'm saying to them, no, go ahead. Please tell me why you don't want to use my book contract. It's fine. Go ahead. Tell me. And as someone starts to get incredibly uncomfortable with your presence, staring them down about why they need to be honest about what they think about my book contract, or me applying for the catering job to cater the gala event this year, or you didn't like my ideas for the XYZ, everyone in the room then understands why you want someone to physically remove themselves from the room while you're having what should be an honest discussion about the bids that came in or the contract that you're reviewing. And I always have board members say, you know, I really shouldn't have to leave the room. We're all adults. The problem with that is there are way too many instances where contracts get approved. And I've had people say to me afterwards, well, I really had some things I wanted to say, or some information, or at least wanted to raise the conflict situation. And they don't do it because the person is sitting in the room. The really important part of all of this is you need to have a candid, open discussion about whether or not that really is the best deal for the organization. And you want to document for the IRS when they take a look at these minutes that the person wasn't in the room exerting influence. And so you want to document in the minutes that the person made the disclosure, they left the room, and then the board discussed it and made a decision. And we've had instances, Brenda and I both, way too many that we're comfortable with, where the IRS later audits a situation where looking for excess benefit transactions, which we're going to talk about, which are conflict of interest situations, and you want it clear that the interested person wasn't in the room. So those are the mechanics and the rationale for having that person leave the room, or in today's world, get off the phone. You really want to be able to demonstrate that they were not in on those discussions and they weren't influencing the discussion. Brenda, do you have anything you want to add to that?
No, I think you nailed it. I've seen your desk there and it's quite scary.
Me? So, but that's why we do it. So each year, our recommendation is that your conflict of interest policy requires an annual affirmation. I got the policy, I read the policy, I agree to the policy, and I understand what it requires, and then a disclosure of any conflicts that they might have with the organization. And it's an ongoing disclosure. So if something comes up during the year that would create a conflict, then they have a duty to amend that disclosure. So that's our recommendation. Excess benefit transactions, you've heard me mention this, and it is the federal side of conflicts of interest. And the gist of these rules are they're specific to C3 organizations and C4s. And it's really anytime there's a related party transaction, so an officer, director, family member of any of those individuals, and the family members go to spouses, children, grandchildren, parents, they go up and down the lines. So you really want to be careful about how broadly this net is cast. It is a broad net. And the reason for that is we don't want people taking advantage of our tax exempt organizations. So again, this is specific to C3s and C4s. And it's anytime there's a related party transaction, the tax exempt organization that needs to get fair market value or better. And if not, then the person who got the really good deal, they're called disqualified persons in the tax world, they are going to have a penalty assessed against them personally. And their penalty is they get to pay back the excess over fair market value to the nonprofit, plus interest, depending on over the period of time. And then they get to pay 25% of that amount to the IRS. Just in case you're wondering, in case they don't pay it back during what's called the correction period, and there are all kinds of time rules for calculating that, the penalty goes up to 200% that you get to pay the IRS, plus you still had to pay everything back to the nonprofit. So it's not a great deal. And in the sample regs and things that came out, embezzlement can be an excess benefit transaction. And if you think about the rationale for that, if I'm the CFO and I embezzle money from the organization, that's not fair market value, right? Because you agreed to pay me $100,000 a year and I embezzled another few $100,000, right? That was clearly over fair market value because you only thought I was worth 100,000. So you have an obligation to the organization to seek recovery of that money. Please don't commit extortion while you're doing that. We don't like that either. So we do not recommend that you write the letter that says, if you don't pay this back, we're going to report you. That's not what happens. You're going to report it. You're going to do your duty and file. So you really need to be careful when you're in this area. And for those of you who read the 990 that gets filed, which we're sure all of you do as officers and directors, there is a question on there, and Brenda can recite probably the exact language, but it's something to the effect of, did you engage in or become aware of an excess benefit transaction during the year? And that's the year that you're reporting. And they ask it that way because you may know about it, but you also may have become aware of one that happened in a prior year. So when you get to answer yes to that question, then there's a few other forms you get to fill out and disclose the name of the person that was involved in that. And if you think about, this is the tax lawyer and the accountant thinking these rules all fit together so nicely, because you have a duty of good faith, a duty of care, a duty of loyalty under state law that require you to do due diligence, that require you to investigate and ensure that you're only selling things at fair market value or better to get a good deal for the organization. If you comply with those duties, you shouldn't find yourself in an excess benefit transaction. But if you do, you are supposed to take steps to rectify it. And again, the very last bullet point on this is document your due diligence for fair market value. Because if you do, then you are documenting for the IRS many, many, many years later. And Brenda can talk to you about how many years later this often comes up, because it certainly isn't right away. So I'm going to switch this over to Brenda now to talk to you about fair market value and ways to get there.
Well, and before I do that, I just want to ask, I want to have another question for you. So I'm sitting on the board. Bob is lobbying heavily for this contract. I know we're paying him too much, but what do I care? The penalties are just against Bob, right?
Oh no, Brenda, I'm so glad you asked that question, because I did forget to mention you as a fellow board member for knowingly approving an excess benefit transaction can be personally sanctioned. And there's always someone in the room when we're live who raises their hand and said, yes, but I have D&O insurance that will cover all that. And we get to let you know that no, your D&O insurance won't cover that, because these are personal penalties. And so your D&O insurance usually will not cover these. You get to pay these out of your pocket. And Brenda, just because you're going to be the super wealthy donor that they got to sit on the board to make lots of contributions, the IRS can sue you for all the penalties for your fellow board members, and then you get to go after them. These are joint and several penalties. So it's a very interesting set of statutes. There's incentive here for the board members to always do the right thing. And this is the time when people say, well, maybe I should resign. No, maybe what you should do is just do your due diligence and comply with your fiduciary duties. We like that better.
Yeah.
So,
because those board level penalties, and also management, those penalties can be assessed against management who knowingly approved it was an excess benefit transaction. So if at the end of the day, it just becomes a difference of opinion about what is fair market value, then if you've done your due diligence, you're protected from that penalty, because you did the work and you did not know, based on the work you did, that it was an excess benefit amount. So to reiterate what Candace said, it's important to recognize that there's a conflict of interest. It's not illegal to have a conflict of interest. It just becomes important to manage the conflict of interest so that the best interest of the organization is preserved, and not the interest of the person who has the conflict. So it becomes, now that we know that there's money on the table that could come out of my pocket if we get this wrong, it's important to understand what is fair market value. That is in the eye of the beholder. So the standard is very similar to the standards that Candace had mentioned before. We're talking about what would be paid to a like person with like skills and responsibilities by a like organization. So a like person, not the disqualified person who we might be tempted to pay because they lost their job, or non-business reasons why we might, or we just like Bob, or Bob scares us. Those are non-business reasons. But if we were going to pay somebody for purely business reasons, we would look at their like skills. If they had similar education or similar experience or similar training. If we need somebody with a certain level of soft skills, with certain technical skills, we're evaluating, can this person do the job? And a like organization, we're talking about an organization similar in size, similar in complexity, similar stage of organizational maturity. You do not, however, need to consider the organization's tax-exempt status. And I put it that way on purpose. As a nonprofit tax-exempt organization, you're still a business. You're a mission-based business, but you're still a business. What's different between you and the business down the street are really two basic things. One is your mission-based business, not necessarily a profit-driven business, and you have a different tax status. It does not mean that you don't make the same kind of business decisions based on the same sort of business considerations. You look at return on investment. You look at, is this going to be the right service for the organization? So you can compare yourself to for-profit entities who are similar to yours. If you are a hospital, the fact that you're a tax-exempt hospital, when you're making these sorts of business decisions, really shouldn't be any different than a taxable hospital making similar kinds of business decisions. So if you need to pay your executive director a certain amount to attract them to your organization as opposed to a for-profit organization, you can do that. So it's not about your tax status, but it is about complexity, similar industry, similar line of business, similar stage of development. So you're looking at those considerations. You're also looking at, for instance, suppliers and contractors. So how do we determine fair market value? Do some comparison shopping. You've got Candace, great attorney, wants to do your business, and she tells you what it's going to cost, but how do other attorneys price these things? She comes with a firm of a certain size and a certain background. You get to weigh that. So not looking at lowest bid, but the lowest fee for the same quality of service, the same quality of consideration. So you certainly don't want to pay the cheapest person to build your headquarters and have it collapse during your first board meeting. That would be bad. You want somebody who's got a good reputation, who can secure the materials in time to meet your deadline for having the thing open, or who can deliver on the contract. So you might put it out for 3 bids is pretty standard, or open it up to the community for bidding and let your board member bid along with everybody else. Have it go through the same criteria. What do you do about employees? Similar concept, but the mechanics are a little bit different. You can also, if you have a general knowledge of the market, so you're hiring an executive director and they're working full-time, and it's a decent sized organization, there's several employees, and you're going to pay them, they're qualified, you're not hiring them just because it's a board member's niece who can't otherwise find a job, and you pay them $50,000 a year. You probably don't need to spend a lot of time developing argument for what is fair market value. That's not a super high salary. You have some idea of what other organizations are paying of a similar size, and you feel like that's a reasonable amount, you're probably fine. But the more you pay, the more work you really need to do to back that up. And so there's some other things besides just general knowledge of the market. There are salary surveys that are widely available. You can adjust those for cost of living information in your market. So compensations, so you originally had decided to hire somebody for a certain amount. You don't necessarily have to do a salary survey or something every year if you're just adjusting it for cost of living. If it's a lot of compensation on some unique benefit packages, you might hire a compensation study particular for your organization and particular for the position that you're hiring for. Here too, it's okay to pay above 50% of the market when the organization is reasonably expecting better than average performance. It's not okay to even pay 50% of the market if you're not expecting that much of the employee. So sometimes you can afford a Cadillac, in which case that's going to be more than 50% of the market. Some cases you can't afford that, and it might be less. So you really need to look at where whoever you're hiring stands in relationship to their peers for the organizations you're comparing yourself to. Giving you some information about salary surveys here. GuideStar has a salary survey that they put out. They do charge for it, but it's not a lot of money. It's a lot less than the penalties for getting that wrong. And their salary survey is divided up by region and size of organization and what sub-industry your organization's in, and it filters out for a lot of things. But their information is just based on information that gets pulled from the 990 returns. And so that information is as good as the organization's completing and disclosing all the compensation in those 990 returns. There are industry associations who put out compensation, comparable information based on particular industries and healthcare, hospitals, arts organizations, behavioral health, all have that available to them. If you don't have it in your market, you can find it in another market. You can use the cost of living information to adjust to your location. There are HR consulting firms such as Mercer or SHRM that do studies, and some local universities do studies, compensation studies in their area. So take a look. There is information out there, and be sure when you do that to include total compensation, not just the base pay or not just what shows up on the W-2. So if you are providing housing for your executive director, if you're providing spousal travel, those deferred benefits, things, money you're putting away for their retirement, that all gets included in there. So if you're not sure what to include, ask for some help in that area. One of the major things that the IRS looks at in this area when you do those compensation studies is they have found a very high rate, in their opinion, of comparing yourself to organizations that are not like you. If you're a dog shelter, but you note that the National Kidney Foundation pays their people a lot of money, that's probably not comparable organizations, although it gets you the answer that you want. So be careful about those sorts of things. Board committees. There is a lot of discussion about what to do with committees of the board. As Candace mentioned, you can delegate certain responsibilities to committees. I would encourage you to have a committee charter so they understand what's being delegated and what's not. I have sat on untold numbers of committee meetings where they said, okay, now do we approve this, or are we just making a recommendation to the board? And they don't know the answer to that question, and they should. So that should be clear. Depending on the size of your organization, it's going to have a lot of influence on how many of these committees you need to have and how many of these committees you can competently staff. Again, to Candace's point, if you don't have enough financial people to cover all these committees, you might need to consolidate them, because you can't rely on the committee if they're not competent to do it. So one of them is the finance committee. A lot of organizations will have a finance committee. Sometimes this happens in the executive committee, but a finance committee is responsible for the oversight of the financial resources of the organization. It ensures the organization's financial resources are used in line with the mission and strategic goals of the organization by making sure there are appropriate policies and procedures in place. And I frequently have conversations with my clients about what is your exempt purpose and what is your mission? Because there's a lot of good to be done in the world, and it is very tempting for organizations to step outside of their exempt purpose and step outside of their mission, which can cause issues. So it's important to keep your eye on the goal and not just do every good thing that needs to be done in the world, but to stay focused on your mission. Failure to do so can cause problems with your tax exempt status, can unwittingly create taxable income and some things to that organization. If you want to change your mission and your exempt purpose, do it intentionally. But you're going to look at things like timely and accurate financial reporting, both internal and external, helping the board understand the organization's finances and the financial impact of the board's decisions, oversight of the budget process so that you can look forward and anticipate financial problems, safeguarding the organization's assets, and complying with federal, state, and other reporting requirements. This is different than the investment committee. Candace has a comment.
I just want to make a quick comment about committees and what's in your bylaws and what may be outside your bylaws. So Brenda mentioned a really good idea about having committee charters. So I see some organizations that try to fit everything about all their committees in their bylaws, which makes your bylaws really long. And then anytime you want to amend something about the committee or create a new committee, you're trying to amend your bylaws. So it might be nice to have in your bylaws some information about what are advisory committees and what are board committees of the board with board delegated authority, as opposed like an executive committee, and then advisory committees that make recommendations to the board, and then create committees by resolution of the board and adopt charters. So I just wanted to mention that, because rather than having to amend your bylaws, you can have a nice solid article about creating committees and generally whether they have board authority or not, and then create charters. So I thought that was good advice from Brenda about having charters.
Also, you're going to get the slides. She's posted the slide link, so I'm not going to read all the distinctions between the few financial committees I'm talking about, but just really point out the finance committee oversees the finances. The investment committee, very similar, only it oversees the investments. And obviously there's going to be some overlap perhaps between those skill sets, but there's some particular skill sets for an investment committee, particular skill sets that you would be looking for a finance committee that would be different. And we also have the audit committee, and they should be separate from the finance and investment committee, separate from really the executive committee, because they should be independent of management as much as possible, because they're in charge of oversight of the internal controls of the organization and also selecting the independent auditor and receipt of the audit results. So ideally those are separate, because you don't want the people in charge of auditing be providing oversight to their own decisions. So the internal control structure is typically decided by the finance committee. Then the audit committee is responsible for checking to make sure that those controls are strong and are implemented. So it's good to have separation. With that said, you don't always have enough people, enough skill set on your board to have all these separate committees. So do the best that you can. It's also generally allowed to have non-board members be on these committees. And you usually will have some board members be on these committees, but to supplement the skill sets, you might invite people who are not on the board to also sit on these committees. Candace, you want to chat about insurance a bit?
We're going to skip through these pretty quickly because the slides are pretty detailed on these. I want to let Brenda have time to talk about the 990s, but we're mentioning in here that you need commercial general liability. If you have employees, you're going to need workers' comp. And then there's D&O liability, which most of you are going to want to have because you have directors and officers. And then we've got a couple of other types of policies listed in here: property insurance, employee dishonesty and crime, which is usually going to be separate from your property insurance. You may need umbrella or excess liability insurance. I've also mentioned in the property insurance, you may need a computer or electronic equipment or a cybersecurity A lot of these coverages are separate, and if you haven't looked at your policy coverage in the last few years, you need to do so. Business auto, so get with a good insurance rep and go through your coverages. Do that pretty regularly. I'm going to
Oh,
switch it back to Brenda to finish us up here.
okay. So what sort of policies should you have? In addition to the conflict of interest policy and charters for your boards, some other things. The IRS has some interest in your policies. One of the biggest assets an organization has is its tax exempt status. Obviously, if you had to pay tax, that would be a pretty big financial impact for a lot of organizations. So that's a pretty huge benefit. So one of the things you need to make sure of is that you're filing your 990 returns. Almost every organization, with the exception of churches, certain religious organizations, certain political organizations, employee benefit plans, and certain governmental organizations have to file a return every year in the 990 series. And there's a 990, 990 Easy, 990N, 990 BL, 990 PF. But one of the appropriate one in that series is if you don't do that for 3 consecutive years, you automatically lose your tax exempt status. I'm representing an organization right now who thought they had been filing. They delegated a lot of stuff to their bookkeeper who ended up, and so there was some confusion over who was going to sign it. So no one noticed that no one was signing it because it didn't get filed, and that didn't get noticed for a period of over 10 years. So they had lost their tax exempt status a number of years ago and didn't even know. So be on the lookout for that. There are also penalties, financial penalties for filing late or incomplete returns. And so protect your assets and have some policies around that. We'd mentioned that every tax exempt organization gives up the right to do some things in exchange for their tax exempt status. Candace mentioned the common ones for 501c3 organizations, but there are rules that apply to other organizations. 501c7, which are social club, country club kind of organizations, are limited to the amount of activities they can have with non-members. So they all have rules. You need to understand what those rules are so that you continue to operate within the appropriate rules applicable to your tax exempt status. Payroll withholding. The government has some very strong feelings about employers, whether they're tax exempt organizations or not, but employers who withhold payroll taxes from their employees and then don't pay it over to the Internal Revenue Service. And organizations will do that, of all types, will do that when they get into cash flow situations, because the government doesn't know how much they owe and doesn't call them on a weekly basis and say, I'm going to cut off your supply if you don't cut me a check. So you'll pay your vendors first and get around to the government when things get better. The issue here is that if that happens, there's something called a trust fund penalty. And so the IRS can go against any person who is responsible for collecting and paying the withheld taxes if that failure is willful. The board is responsible for making sure this happens. They're not the only ones responsible. The CFO, the person who does the payroll might also be responsible parties. But if you're responsible and your failure is willful, you can be subject to the payroll withholding trust fund penalties. Willfulness exists when you have been or should have been aware of the outstanding taxes, and you either intentionally disregarded the law or were plainly indifferent to its requirements. So there's no evil intent or bad motive required. You should have been aware of that the taxes weren't paid. For instance, when you get the financial reports and the liability for payroll taxes continues to grow and grow and grow, but your payroll is staying the same, you should be able to get from that those payroll taxes aren't being paid, and which opens you up as a board member for exposure to those penalties. And the the penalty is 100% of the tax owed, and it's joint and several. And so they can just pick the person who's the easiest to collect from, and then everybody that has to that person has to try to collect from everybody else. The IRS also has a list of suggested policies, and these are only suggestions, but they are policies that the IRS thinks are best practice. So you should pick the policies that apply to you, pick the policies that are healthy for the organization. The IRS does not say what needs to be in those policies, but here's a list of policies that you should be at least considering. I'm going to particularly point out the board review. There's a question in the 990 that asks about that. There's actually a question that asks about all of these policies. But some people think that the board has to approve the 990, that the IRS requires it. The IRS does not require that. The IRS simply asked if the board got a copy of the 990 before it was filed. The board's not always the right organization to do the review. They don't have the skill set, so that might happen at the audit committee or the finance committee or the executive committee. If in fact nobody approves it, that's also not illegal, but it's good to have some policies around that. Knowing that the IRS is asking, and the 990 is a public document. So the government as well as other readers will judge you based on your answers. I also want to talk about really briefly financial information. You've got internal financial information that you need to understand. It should be timely and responsive to the needs of management and the board. So there's no particular format to this kind of financial information. You need to design it so it gets you and management the information you need to fulfill your responsibilities for the organization. The external financial statements, there is some dictated formats to that. They're typically expected to be in conformance with general accepted accounting principles. You've got your statement of financial position, which is equivalent to a balance sheet, your statement of activities, which is the income statement in the not-for-profit world, your cash flows, your statement of functional expenses, footnotes, consolidated schedules, and your audit report. A lot of organizations are very proud that they're audited. It's important to actually read the audit report to make sure that there aren't some things in there that would alert you that there are issues with the organization. Also, you need to consider grant reports. A lot of grantors require financial information related to their grant, and they dictate the content of those. So make sure you've got some people on your board who understand that and who can help the other board members understand that. You might also want to consider including that in your board training. Giving you a list of some yellow light indicators. If you see this kind of activity in your financial statements, you might want to ask some questions. They're not, I don't call them red light indicators because they might be fine, but they're worth asking additional questions about. And then also a list of green light indicators. So these are things that when you look at, like, oh, that's great. It is important as a growing enterprise to have profits sometimes. That's what fuels growth. That's what covers cost of inflation. There's nothing wrong with a not-for-profit to have a profit. You need to do that over time. But in particular years, you might plan on a loss, or losses might happen, and that's fine. But make sure you're making good financial and business decisions for the organization so that you're around for the long haul. Also give you some information about the 990 return itself. Some things to look at here. Page 1 is an executive summary. So most of the information on page 1 is found elsewhere in the return. Part 3, which is on the second page, is where you list your program service accomplishments. This is a really underutilized section. It's where the organization justifies their tax-exempt purpose and gets to proclaim to the world the wonderful impact you're having in the community. And a lot of times in the 990 return, this is not a very inspiring disclosure. We took care of old people, or we had some exhibits if we're our arts organization, but it doesn't really talk about impact. However, when you look at the fundraising materials, there's lots of information about impact. This is where you put your impact. other places where the press and the public look is part 6 of where you have your governance disclosures. It asks questions about what policies you have. Part 7 is a compensation disclosure. People like to look and see how much you're paying your executives. So you want to have a really good explanation of how you set that compensation. Part 8 is a statement of revenue, which should agree to your audited financial statements or your formal financial statements at the end of the year. You don't have to have an audit. There's no tax IRS requirement to have an audit. The statement of functional expenses. Most organizations, nonprofit organizations, have to have a statement of functional expenses now in their formal financial statements under GAAP, but only 501c3 and 501c4s need to fill out the natural expenses. We've got the balance sheet. There's also 16 other schedules that you only complete if they're applicable to you. So if you're a 501c3 organization and you have a Schedule C with political and lobbying activities, you can be sure people are going to look at that to see if you are breaking any of the rules for qualifying as a C3, for example. If you're a hospital, people are going to look at Schedule H to see what you're doing with your community needs assessment and various issues like that. So overall, our recommendations are to attend the meetings, be involved, ask questions, review the policies, because they get stale after a while, so keep them fresh. Trust management, but do verify that they're following the policies. And remember, you are the fiduciary of the organization, so be a leader when you join a board, not a follower. And thank you for your patience, for your questions. We'll get back to you. And someone added, develop a plan. Very good advice. So thank you very much.